Hello, Lanas. Welcome back to our segment. I am instructor CPA Ringo Frederick. Remember, we are on our revision period, and today's segment will be looking at management accounting. And the concept that we'll be handling today specifically, it is the application of marginal costing. Remember, when we are talking about application of marginal costing, we are focusing majorly on making our decision based on the variable cost that we'll be incurring. So under this application of marginal costing, we normally tend to talk of several items of cost, which will include the aspect of CVP analysis, right? We'll be talking about the concept to do with, of course, limiting factor. Yeah. We'll also be talking of concepts to do with make or buy decisions, right? Talk about accepting or rejecting offers, accepting or rejecting offers. These are what we'll be looking at an application of marginal costing. And by the way, our revisions are on. So if you have not joined our revisions, kindly make sure that you join our revision as soon as you can. With the remaining period, this period can make a lot of difference. This period can make a lot of difference. So make sure that you have joined our revision segments, which are ongoing. Of course, you can always reach us out on the number indicated below this video. Our focus today will be on CVP analysis, application of marginal costing. Key area is CVP analysis. Key area is our CVP analysis. So when we are talking about CVP analysis, the main application will always be talking about the concept of break-even point. We'll always be talking about the concept of break-even point. So anytime you're looking at a break-even point, we are looking at the level of production where my total revenue is equal to total cost. At that point, that is to say, our profit will always be equal to 0. So looking at this case, break-even point will be having a break-even point in quantity. To determine this, we'll always be talking about our fixed cost over contribution margin. Contribution margin is simply our selling price per unit minus variable cost per unit. That will also take us to understand a break-even point in value. So break-even point in value, we have two methods to work it out, where we normally talk about fixed cost over contribution margin times our selling price per unit, or simply we can talk about fixed cost over CS ratio, right? Where the best time to use the first case is where you're given selling price per unit and variable cost per unit. The second scenario will be applicable where we are looking at the concept of where you're given the total sales and total variable cost. That is important to note. Then it will also be important for us to understand the break-even point for multiple products. Break-even point for multiple products. This is in the event where you're dealing with more than one product. So to do this, we'll always be having this in mind. Fixed cost, we divide by the weighted average contribution margin, or simply you talk about your fixed cost over CMR. That is summation of contribution margin ratio and summation of course, our weighted average contribution margin. So these are the key areas that you must always be able to understand anytime you're dealing with what? Break even. Then the other key element that you should also be able to understand here is that when you're dealing with break even point, there are these areas which are very common, where we normally tend to talk about margin of safety. Margin of safety is simply the range between the point that you'll be making talk about you won't be making anything, that is the point of break even point, and the sales that you're making. So it's simply that range between our sales minus what? Our break even point. This is simply the range. The sign won't matter. The sign won't matter. So in this case, we'll find that we are looking at margin of safety as the range. Then understanding it better, you'll find that for break-even point also concept, many a times you'll always be required, of course, to determine this case. You'll always be required to determine the target, talk about the target sales, either in quantity or in value. So to determine the target sales in quantity, we'll always be talking about our value being fixed cost plus the target profit that you're given, fixed cost plus the target profit that you're given. We are going to divide all this by our contribution margin. And to determine the same in value, target sales in value, we'll always be talking about our fixed cost here. We add our target profit, we divide by our CS ratio. Or simply, you can take it as fixed cost plus target profit times the selling price per unit. That also can give you what? Can also give you, of course, the target sales in value. So this is just but a summary of what we need to understand. And I gave you this in details, of course, in our coursework. So by doing that reminder, let us go straight to a question in our block model paper. A question in our block model paper. So this question of block model paper, part one, of course, you asked define marginal costing and give its limitation. I'd already given you that one, so I won't do it again. Part B of the question you asked, the following data relate to Kiwandani Limited for the year ended at 1st December 2023. Where we are given the sales, we are told we less total cost, then I'm having the net profit. Fixed costs account for 40% of the total cost given at that point. Required, a good examiner wants us to determine the margin of safety. Part two, we are supposed to determine the break-even point in sales. Number three, sales required to earn a profit of 6 million. In order to increase sales, the management has the following two options: to increase sales by 25% on incurring a sales promotion cost of 2.5, and to increase the sales by 15% on reducing the selling price by 5%. So you're supposed to advise the management on which option they should take. So once you have that concept, you'll find that whatever that you're being tested there is what you did, right? And what you've just done a review on. So given such a question, my good students, you're asked of margin of safety, you're asked of break-even point, you're asked of the target sales, and of course, to the point that will also be required to advise the management. So once we have that in mind, our task will be tested, or rather our task will be for us to determine the details given there. So I'll just quiz this question, believing that it will still be visible if it is on that corner. So number one, you ask of margin of safety. And you know very well that you can't determine margin of safety not unless you have what? A break-even point. So the task which will be important for us is for us to determine our break-even point. And the question that you're going to ask yourself at this point, which method are you going to use to determine the break-even point? Given that this question, you are already given the number of units, you can see you are not given the number of units, and we are not given the selling price per unit or the variable cost per unit. So therefore, the best method to approach here would be the fixed cost we divide by our CS ratio. This will be the best method applicable in that question of ours. Then, on this case, we know very well that anytime you talk of a CS ratio, we are talking about our contribution we divide by our sales. The good examiner has given us the sales because at this point, recall, for you to determine your contribution, you must always be talking about your total sales minus your total variable cost. Total sales minus total variable cost will always give you contribution. Our case, if at all you can look at our note, just below we are told that this person or the company, the fixed costs account for 40% of the total cost. The fixed cost account for 40% of the total cost. So therefore, we can all agree if that is the case, our fixed cost will be having our fixed cost to be, we have our fixed cost here accounting for 40% of our total cost. Yeah. Total cost, a good examiner had clearly given us where you're told that our total cost was 20,000. See? So total cost, we are given a value of 20,000. So we can agree that my fixed cost is 40% of that, 40% of the 20,000, which will give us, of course, that is 8,000. Therefore, my variable cost will be, our variable cost in this case, we can all agree, will be 60%. So 60% of the 20,000 will be having a value of 12,000. Yeah? So having our variable cost, can we determine our contribution? Yes, we can determine our contribution. My good students, our contribution in this context, we should all agree that I'll be having what? I'll be having a value of sales, total sales, which was 24,000, minus our variable cost, which you can see is 12,000. So therefore, we can all agree that our contribution, I'll be talking of 24,000 minus 12, of course, which will give us what? 12,000, right? So our contribution here is 12,000, which in this case, having our contribution and having our fixed cost, can we determine our break-even point? We can determine our break-even point, right? Which in this case, to determine our CS, that will just be simple now. I'll be having our that is our contribution being 12,000. We divide by our sales, which is 24,000. So therefore, we can agree our CS is what? 50%, or literally 0.5, being our contribution to sales ratio. Contribution to sales ratio, I should be talking of 0.5. Once we have determined our contribution to sales ratio, the next target will be easy, because I'll be required then to determine our break-even point. With a lot of confidence, we can agree that our break-even point, therefore, I'll be having my fixed cost, which we have seen it is 8,000. We divide by CS ratio, which is 0.5. So we can agree that at this point, our break-even point will be 1,000 divided by 0.5 to give us what? 16,000. So in this case, I'll be having our value, which is 16,000. Okay. Then my MOS, margin of safety, therefore would be my margin of safety. My good students will all agree that according to what Mwalimu had given us, we are looking at the range between our sales, which was 24,000, minus 16,000, which is our break-even point. Therefore, our margin of safety will be 24 minus 16, which is giving us what? 8. Yeah. So our margin of safety, all of us, you can agree, I'll be having 8,000 there. Very important, very important. So in that case, we've literally handled part 2, which you are told to determine the break-even point in sales and margin of safety. So part 3 of the question you asked Sales required to earn a profit of 6 million. Mhm. Target sales in value. Mwalimu had just given us that when you're doing our summary. Mwalimu had shared with us this when you're doing a summary, where we said I'd be talking of our fixed cost here plus our target profit. We divide by our CS ratio because we need to determine that in value. Where in this case, my good students, we do have our fixed cost, which is 8,000 that we have determined. We add the target profit, which our good examiner is giving us 6,000. We divide by our sales ratio, which we have determined to be 0.5. So therefore, the target sales in value that we should be required to have would be 1,000 plus, of course, 6,000 divided by 0.5, which is giving us what? 28,000. So in this case, Mwalimu is getting 28,000. You can all confirm with what you're having. So we have that point. Yeah. The other part, what were we asked? The other part of this question, which we were asked, of course, but for the question, in order to increase sales, the management has the following two options. Option one is to increase sales by 25% on incurring a sales promotion cost of 2.5. Option two is to increase sales by 15% on reducing the selling price by 5%. So that would be very that is a straightforward question, which in this case we are required to advise, right? So in terms of advising, remember, we'll always advise based on number one, either cost or profit. If it is on profit, we should always tend to go with the option that give us what? The highest profit. If at all it is cost, you should always go with the option that will give us what? The lowest cost. So in this case, in advising, we're having two options. We're having option one, which in this case, what are we told in option one? What are we told in option one? Option one, our good examiner here had told us that we need to, of course, increase our sales by 25%. So my sales here, which currently our sales was 24,000. So we increase our sales by 25%. So by 1.25, increasing our sales. This will give us a value of how much? 24,000 by 1.25 to give us a value of 30,000. You can confirm if at all that is what you're getting. What about our variable cost? What will we be having as our variable cost? Remember, by our knowledge, which Mwalimu shared with us earlier on, I can remove this question. I believe that you guys have a question now. So remember, by the concept or knowledge that we studied earlier on, we said always, yeah, when we are determining this concept, just to take you back here, allow me to erase this point. When we are talking about the concept of ratios, we normally tend to say like, of course, 1 minus variable contribution ratio VCR will always give us what? CMR. 1 minus VCR will always give us what? CMR. So the same case, we can also agree and say that 1 minus CMR, contribution margin ratio, will give us what? Variable cost ratio. And therefore, it is the same as saying our contribution margin ratio plus variable cost ratio will always give us what? Will always give us 1. So in our case, we have our ratio, which in this case, it is CS ratio. So my CS ratio, we have it as 0.5. That is contribution margin ratio. It's the same as CS ratio. So 1 minus our CS ratio, which is 0.5, will give us what? A variable cost ratio. So therefore, my variable cost ratio will also be 0.5. A variable cost ratio will also be 0.5. 0.5 of what? 0.5 of our sales. So in our case here, when we are required to determine our variable cost, I'll just be having 0.5 times our sales, which was 30,000. So that at this point, I'll be having what? 15,000. That's our variable cost. So by this fact, we can agree that my contribution here, our contribution at this point, will be having a value of 15,000. But option 1 is telling us that we are going to incur an additional cost. Additional cost of what? Additional cost of promotion, sales promotion cost. We're going to incur additional cost of sales promotion cost. So sales promotion cost, I'm going to incur a value of 2.5. So therefore, we can all agree that the total profit that I should be having here, because remember at this point, fixed cost is irrelevant. Whether you produce or not, you're going to incur your fixed cost. So the first case here, I can see we are getting 12,500. This is option 1. The profit that we're going to earn is 12,500. That is without the fixed cost. Fixed cost in this case, it is irrelevant. And I'm going to show you why you'll find that it won't assist us, of course, in making this decision that well. So after we are through with that, we check the other part. The other part in this case, we have option 2. What about option 2? If at all you can check option 2, what were we told in option number 2? Option number 2, my good students, these are what you are told. Look at option number 2. A good examiner had asked us here that option 2, we need to increase sales by 15% on reducing selling price by 5%. We increase our sales by 15% while reducing our selling price by 5%. But you're not given the selling price per unit. So how do you go about your sales? So our sales would be, we are going to increase our sales by 15%. And at the same time, we are going to reduce our selling price by 5%. So I'll be having 95%. So therefore, what will be our sales? My sales in this case, I'll be having 24,000 times 1.15, of course, times 0.95, reducing our selling price. So in this case, I'll be having 26 to 20. I'll be having 26 to 20. 26, 220. We increase our sales at the same time reducing what? By reducing our selling price. So at that point, what about our variable cost? Our variable cost in this case, I'll be having it as our contribution, or rather our VCR, which was variable cost ratio, which we are determining to be 0.5, of course, times 26, 220. Which in this case, I'll be having what? Times 0.5 to give us what? 13,110. So in this case, I'll be having 13,110. So therefore, we can all agree that our profit, in this case being contribution, we'll be talking about 26 to 20 minus answer, I'm getting 13,110, the same value, right? The same value, 13,110. See? So these are what we should be having. So in advising, what do you think? Having the two methods, option 1 and option 2, and this is why Mwalimu was saying that fixed cost will be irrelevant. Because remember, fixed cost is not changing, even if you take your fixed cost here, which will be 8,000, and at this point you have 8,000. Your fixed cost is basically irrelevant. So being irrelevant, you'll find that it won't have an effect in your decision making, because in this case, you can basically advise on this. Option 1 is giving us a profit of 13,110. Option 2, or rather option 2 is giving us that. Option 1 is giving us 12.5. So therefore, in this case, you can agree that you can advise the management to go with option 2 of increasing our selling price by 15% and increasing our sales by 15% by reducing what? Our selling price. So once we have this, you'll find that you can go with option 2. Even if you're to consider the aspect of fixed cost, which will be irrelevant, you'll find that for option 2, I'll be having 13,110 minus 8,000 to give us 5110. Whereas this should give us what? 4,500. So you'll find that still, in this case, we'll go with option 2. So many a times, whenever you're dealing with the application of marginal costing, many a times the concept of fixed cost will be irrelevant. So these are what you're supposed to do in this question. Remember, we have most of these questions, of course, in our block model paper, which I'm going to do after this. I'm going to attach this block model paper just below our video so that you can be able to access it. Remember, if you've not joined our classes are on. Make sure that you join as soon as possible. With the remaining time, you can still make a lot of difference. To that point, guys, thank you so much and see you in our next class. Bye-bye.